He's Allan Boomer. He is the Chief Investment Officer at Momentum Advisors. These are larger stocks. We are very familiar with them, Microsoft and Meta. Allan, tell me why these jump out to you and what your strategy is right now.
Sure. First of all, thanks for having me. We've got to talk a little bit more macro, and then I'll get into the micro. Macro, big picture wise, I am concerned about a lot in this economy. We have about 5 million jobs that are going unfilled, not enough workers to fill those jobs. I don't know if the Fed can really help that or not. And then we've got inflation. And so when I think about, a market where there's not enough workers and where prices are rising, I want to be in companies that are very, very profitable, that have a really high profit margin. And so when I look at Meta and Microsoft, these are companies that have above average EBITDA margins.
Where would you definitely not be?
Yeah, so I would be avoiding companies on the opposite end of that spectrum, companies that trade at high multiples that are sort of not profitable, or companies with really thin margins, because you really want to be in companies today that have pricing power, that are not overly reliant on labor also.
Right. So again, Microsoft, Meta feel kind of like safe places to be right now. They have a proven track record. The PE ratios look far more appetizing than the price to sales ratio some of their smaller counterparts are trading at. Then I see Prologis on the list. Why this one in particular?
Yeah, again, so Prologis is really a high margin business. I love the space they're operating in, which is e-commerce. E-commerce was already on the rise prior to COVID. It's continuing to be strong. And they're leasing to e-commerce players. And in order for goods to get from a warehouse to your home, they've got to stop through one of these distribution centers. And that's what Prologis is in the business of, is owning the real estate that backs the e-commerce value chain.
Can you explain to me, Allan, why Prologis, which let's call it's kind of like a tech e-commerce play, is basically at all-time highs? We're $2 off of that right now, at a time when FedEx is 33% off its highs. The Dow Transports is down 6% in a week, had a terrible session on Friday. What gives? I mean, if anything, I think an e-commerce play would do even worse right now because we're supposed to be having a post-pandemic normalization hangover.
Well, when you think about those transports, what's a big cost input? It's gas, it's oil, it's jet fuel. Right, and those prices are through the roof. But when you talk about the real estate, they're not as exposed to those commodity pressures.
So what do you mean by that? They versus who?
Sure. When I'm talking about a Prologis, which again is very much a staple in that value chain of getting a good from a manufacturer's facility to the end customer, the real estate is being leased to, again, some of these producers that have to use warehouses. They can't just ship it directly to the consumer's door. It has to be reassembled. It has to, be stored for a little while, even if that period is a short period of time. So again, I just think the real estate is less exposed to the commodity prices, and that's why they're doing better than the transports.
Shepard Smith here. Thanks for watching CNBC on YouTube.